everyone, and welcome to the launch webinar for Mayday Balancer. My name's David Tuck. I'm the co-founder and CEO here at Mayday, and absolutely thrilled to be welcoming you on the 16th of May. It's actually my wife's birthday today, so lots of very exciting things happening today. I will not be drawn on which is the most exciting. And so I'm just going to hand over to Griff to introduce himself, and then we'll get into it.
Hey everyone. I'm Griff, co-founder and CTO here at Mayday. Really excited to be talking to you today about Balancer.
All right, amazing. So let's just set the scene. We have been live for coming up for 13 months now as Mayday. Mayday Recharger was our first product for automating intercompany charges of costs and revenues across your group, taking that from a time-consuming manual task that might take a day as part of month end to a 3 to 5 minute review and approve tick box exercise. Then earlier this year, we launched BRAG, bank reconciliation across the group, for that situation where you have one related entity that either pays a bill or receives money on behalf of another related entity, and you've got the pain of switching between your Xero accounts to find the bank transaction and reconcile it off. And today, so that was sort of multi-entity strikes back with Xero, and today we complete the trilogy with the launch of Mayday Balancer, which we're so excited about. It's the wrapper around your multi-entity needs for keeping your intercompany loan accounts in balance. And so let's just dive a little bit further into the need. Why have we built Balancer? So I'm an accountant, right? And I've been a kind of financial controller. I've been a CFO. Intercompany loan accounts, I mean, it's not great dinner party conversation in any event, I will acknowledge. But if you ever explain it to someone who hasn't kind of lived through the pain, that, well, it's what does entity X owe entity Y, making sure that that's the same as what entity Y shows it owes entity X, and they are, they're related, they're like siblings. Surely that should be really straightforward. Left hand knows what the right hand is doing, doesn't it? But it's only once you've lived that pain that you realize just how easily intercompany loan accounts between related entities can fall out of balance due to posting asymmetry. Something's correctly posted to the loan account in entity X, but in entity Y, it's mistakenly posted as income. FX adjustments, where the £100,000 that the UK parent has loaned to the US sub did equate to $125,000 at the time that the loan was made, but FX rates will always move, and needing to stay on track of posting those FX adjustments to keep the loan accounts in balance. And then finally, interest, and making sure that that is correctly calculated and correctly posted to both entities in line with any interest being applied to said loan account balances. And in my experience, when loan accounts go wrong, so to speak, they always go wrong at the worst possible time. Year end, a funding event, a transaction. And what then results is potentially days of stress unpicking every single transaction to find that needle in a haystack, that culprit of why the accounts have fallen out of balance. And that's why we're so excited to bring Mayday Balancer to life, so that never again will your loan accounts fall out of balance. Those three culprits: posting asymmetry, FX, interest. We're just incredibly excited to bring you Balancer to address all of those needs. So Griff, over to you.
Fantastic. Cheers, Dave. So I'm going to share my screen and we're going to have a little look at it. So We're going to start off with a little bit of configuration. If any of you have used Mayday before, you may well have done some of this already, especially if you've used Bragg. But the first step is to tell us simply where the intercompany loan accounts live. And the first thing I should say, actually, if you are an existing Mayday user, you can go into the products section here and you can activate Balancer as of today and get started. So we're going to say where the intercompany loan accounts live. And because Mayday starts at a particular date, you'll start using Mayday from, in this case, the 1st of September. We may need to know the value of those loan accounts at that point in time. So you can go into Xero, you can look those up from the trial balance report or from any one of the reports and just let us know what those were. And once that's done, Mayday are going to start monitoring those loan accounts and pulling in all the transactions that are in them. And we'll build for you a little dashboard that looks a little like this. And what we're doing here is showing you the current state of each of your intercompany loan accounts. So we've realized here that there's transactions happening between Inc. and HQ Demo, between Australia and HQ, and between Inc. Demo and Australia. And we're going to default to showing you this at the end of the previous month. So you log into this at month end, and straight away you can see what they were at the end of the previous month, so you know what to do. But if you need to change that, we can really easily jump and we can see what it was at the end of March or at the end of the previous year. We can just do that really easy, really quickly, and we'll show you the state of the loan accounts at that point in time. But let's jump back to the end of the previous month, and there's a couple of things here I want to look at. So let's start with the top one. The loan between Inc. and HQ looks like it's got a little bit of an error there. Quite a big one. 7.7% of the balance of the loan is missing from one side. So let's dive into it. So what we're saying here is Mayday Inc. has a balance of $228,000, and that isn't reflected in HQ. HQ has £195,000, which at the exchange rate is about $245,000. So let's dive into it a little bit and see why that might be. So I'm going to hit this loan transaction details page, and it's going to bring up a page like this, where we can see the full history of that intercompany loan. What this page is telling me here is that at the end of March, the discrepancy was 0, so the loans were in balance. But actually, in May, they've gone out of balance. So let's have a little look at why that might be. And we can see here immediately that there's transactions in HQ that haven't been reflected by transactions in Inc. And similarly, in Inc. to HQ. So we've got a posting asymmetry there. I can hover over this. I can see there's an intercompany between HQ and Inc. that probably hasn't yet been reconciled, or perhaps it's been reconciled to the wrong account code in HQ. I can click through and I can see, if I was logged into Xero, of course, that would have been good. I can see the original transaction there, live demos, eh? Or I could click through to the HQ demo. But what we're seeing here is there's a posting asymmetry. So I can then go in, I can correct that, and when I come back, hopefully the loan accounts will balance. Let's dive back in to this screen very quickly. Let's have a little look at the Australia to HQ one. Now, the difference here is relatively small. It's only about $3,000. And let's say that perhaps this is an FX error. That could be for a couple of reasons. One of those reasons could be obviously that we're using the fixer exchange rate, and that exchange rate has changed, and therefore there's an adjustment that needs to be posted. But perhaps you're using an internal exchange rate that Mayday doesn't yet know about, and that's why we think the numbers are wrong. You can click on this. You can tell us what the exchange rate should be, what your internal exchange rate should be. That could be a daily rate. It could be a fixed rate for the entirety of April, or perhaps you use a fixed rate for all time for this particular currency. You can tell us what that is, and then we'll recalculate the loan balance and tell you whether there's any adjustment that still needs to be posted. But let's say this is an adjustment that is correct, and we need to post that. We can hit that button, and immediately Mayday calculates what the journal should be, and with one click, it will post that into HQ Demo at this point, and the FX adjustment has been posted, and your loans are in balance. Really simple. Now, another reason they could come out of balance is because of interest. So at this point, we haven't configured any interest for this particular loan, but let's say it does need some interest applied to it. So I can hit that, and I can say, okay, we need a fixed rate of, let's say 3% for this loan between Australia and HQ. I do that, and immediately we calculate the daily rate for each day of the month, taking into account any changes in the balance throughout that month, and tell you what interest should be applied at this point in time, which is the end of April. And very soon, just as we did with the FX adjustment, we'll be able to one-click post those either as an invoice or as journals into the two entities. Now, let's say for Inc. and HQ, the interest needs to be a little more complicated. So let's say that up until, well, from the 1st of January, this has got an FX rate of 4%. But actually, the previous year, there was an FX rate, there was an interest rate, sorry, of 3%. If I do that, we've configured a variable exchange rate there. I can put in as many of those as I want, where those checkpoints tell us when the interest rate changes. And again, we will calculate the daily interest rate, taking into account any changes in balance and any changes in the interest rate, and tell you what interest should be applied at the end of this month. So there you go. That's Mayday Balancer. Hopefully that's really simple, much simpler than your current processes, I hope. And we're really excited to put it in your hands and see what you all think.
Amazing. Well, Griff, thank you so much for that demo. I jumped the gun at the beginning. I should have said that please do fire through any questions in the chat as we go, but in my zeal, in my eagerness to get your eyes on Mayday Balancer, I skipped that step. But that concludes everything we wanted to run through today. A huge thank you to all of our users who've been involved as beta testers for Balancer. It's been absolutely invaluable to get your insights, which have informed the development of the product, as well as your work to kind of stress test it and make sure that it's ready for us to launch. And so that's everything we wanted to cover today. Please do fire through any questions in the chat. I can see we've got one already been posted. Do we have any plans for taking more of the steps away? For example, not having to go back into Xero to correct posting asymmetry? That's a phenomenal question. And yeah, absolutely. We're really, really excited about the opportunities that we'll have to kind of take away more of that pain in the way that we have done with the FX adjustments, in the way with the interest, and doing more in terms of not just identifying that there is a discrepancy, but the root of that discrepancy, and ultimately how we can help you rectify that posting asymmetry in whichever of the two entities it has arisen in. Another question here: how does Balancer post FX adjustments? Which account codes do they go to? Now, Griff, I know we've had a bunch of kind of fun and games on this with sort of Xero's default FX codes being locked. So I will let you field this one.
Thanks. Yeah, so you will have seen in our account mapping screen as I went through there, there's a box now for the realized FX gains code. So you can tell us in there where realized FX gains go to in each of the entities. And by default, we will post obviously one line to the intercompany balance for the FX adjustment. And then the other line, the balancing line on that journal, will be to the realized FX gains code. Now, if you use the default one from Xero, that's what they call a system account, which they don't allow third parties to post to through the API. What that means really is that we can post the journal as a draft, and then we'll open up that journal for you, and you can add that code back in and approve it. It allows you to post it manually, so we can put the numbers in there as a draft for you, and you just need to finish it off. Or we've seen some customers will actually create their own realized FX gains code, which means you do need to, I think, go and edit some of Xero's reports so that they reflect that new code that you've created. But that means we can post automatically as authorized journals straight the way through.
Amazing. And then just finally, I can see we've got a question about, can I set a recurring interest rate? Yes, absolutely. So you can either set a fixed recurring rate that will always apply to that loan account balance, or you can set the variable rate, as Griff ran through earlier, 4 different rates that should apply to different periods. So you've got the complete flexibility you need to reflect the interest rates that you will apply as a group. Fantastic. Well, unless there are any further questions, we'll wrap it up there and let everyone figure out what they're going to do with all of that extra time that they are going to have on their hands as a result of our trilogy of multi-entity functionality. And this is such an exciting kind of juncture for us. I mentioned we're coming up for 13 months live now. We were absolutely thrilled to win the Xero Emerging App Award last month. And this is the kind of culmination of our multi-entity suite. And we now kind of move into, as you'll see on our public product roadmap, which is also on the website, we're moving into month-end pains that also affect single entity businesses. First up, revenue recognition. So thank you very much for joining us this morning. It's a real privilege to work with you and address your month-end pains, starting with the multi-entity trilogy that we now have. And yeah, I hope you enjoy using Balancer as much as we have enjoyed, and we continue to enjoy developing it for you. Thank you very much.
Thanks, everyone.